We're going to ease into accounting a little bit by reviewing the balance sheet, which hopefully you've seen a little bit before, and introducing something called enterprise value. In short, the enterprise value is going to be the value of the company's operations. But we'll get to that in more details here. Okay, so first we have to review accounting statements. In particular, we're going to review the market value accounting statements versus book value accounting statements. So if you've taken an accounting class, and it's not a prerequisite for this class, but if you have, you've probably done things with book values. Okay, so these are historical cost accounting, right? That's different than what we care about in finance. We care about the market values. We care about how much you're willing to pay for stuff, right? How much investors are willing to pay for pieces of the company. That's going to be different than what the accountants are putting down when they do historical cost accounting, the book value of stuff. So we're going to talk about that difference. Then we're going to do some examples. We want to value in this class, we want to value assets, we want to value projects, right? The emphasis is on valuation. We're going to use the balance sheet to help us think about valuation in two different ways. So one thing you could do, if you want to get the value of an asset, you could look at the value of the debt and the value of the equity for the company. And if you know the value of the debt and the equity, then you can infer the value of the asset. Now, the other way to go is part B here. This is going to be what we typically will do. We want to forecast the cash flows for the project. We want to discount those cash flows and get the value of the asset. Okay. Now, they're both going to need the balance sheet. In both cases, in order to do them appropriately, we need to know a little bit about the balance sheet. In A, it's pretty obvious because if you know debt and equity, then you can infer the assets. For B, what we're going to do is we've got cash flows from the asset, and we're going to figure out the right discount rate based on the debt and the equity. We're going to learn about the debt and the equity, see what the discount rate is there, infer what the rate should be for the assets of the company. Okay, so that's the overview of where we're going for the next couple months. It's all going to start with the balance sheet. Okay, so let's review that. There's two ways to measure value. If you've taken accounting, you've done book values. This is backward looking. You want to know how much did you pay for stuff. If you buy a car for $20,000, it goes on your books at $20,000. Okay. So this is what shows up in financial statements when you go to the SEC and you look at the company's filings. This is what they're doing. Now, from a perspective of valuation, however, we want to know how much are you willing to pay for stuff. How much you paid in the past isn't necessarily a good indication of that. We want to know how much stuff you're going to get in the future. Right? We want a forward-looking measure of value. That's what the market value is doing. Investors are looking into the future and trying to figure out how much value an asset is going to create. That's what sets the market value. That's totally different than this backward-looking book value. We have this identity. We're going to come back to this identity all throughout the semester, and the balance sheet identity. Right? Assets are equal to liabilities plus equity. This is an identity that holds for both book values and market values. Okay, so we're still going to use it, even though we're not interested in this book value. And if you've done accounting, you think assets equals liabilities plus equity, that's all book values. No, the identity also holds true for market values. What this would mean in terms of market values is the company has assets that are worth something. They're generating some value. That value gets split between the debt holders, the liabilities on the other hand, and the equity holders. Right? These two investors are sharing the value of that asset. Okay, so that works for both book values and market values. So let's just do an example, fixed ideas. I think that's the easiest way to see this. I'm going to dock my slides over here. Okay. So we've got this company A, very generic, not very creative names here. It sold $5,000 worth of bonds and $5,000 worth of stocks when it was created last year. It purchased a machine, and the machine cost $9,000. The machine is going to generate $4,000 in cash flows during the year. What do you do with that $4,000? Well, what did company A do? They paid a $3,000 dividend and $1,000 in interest payments. Okay. So what does the book value balance sheet look like, at time one after you've done all this stuff? Okay. Well, so I've just written it up here. what goes on the balance sheet for the bonds? Well, how much did you raise initially? Right, we raised $5,000 in bonds, so that is the historical number that we put into the book value balance sheet, $5,000. Likewise, we raised $5,000 in equity, so that's what goes into the equity slot on the balance sheet. We bought this machine for $9,000. So all the accountants is doing is you buy the machine, you get this receipt for $9,000, and then you enter it into your books at $9,000, right? It's just exactly what you paid for it. So that's what we're putting for the asset on our balance sheet. Now you'll notice we raised $10,000. We only spent $9,000. So we have $1,000 left over in cash. It's all got a balance. Okay. Now during the year, so this is like what happens at origination. As soon as you raise the money, you have $5,000 in debt, $5,000 in equity. Then you go out right away and you buy this asset for $9,000 and you've got $1,000 left. Okay. Now let's see what happens during the year. Well, the machine is going to generate cash flows of $4,000. What does the company do with that $4,000? It pays a $3,000 dividend and $1,000 in interest. Okay, so it's completely paying out the cash flows. It generates $4,000 and then it pays $4,000 back to its investors. Okay, so on net, what is happening to the balance sheet? It's going to look the same, right? Nothing else happened to this company during the year. Right? So it's completely missing those cash flows. So you should keep that in mind. Anything that just goes straight through the company, you generate the cash and then you just pay it straight out, that's all gone, right? That doesn't show up anywhere in the balance sheet, in the book value balance sheet. Okay. So that's what we have here. And then the question is this $10,000 a good estimate of firm value? Yeah. Maybe. We don't really know. We can't really say more. What are we missing? Well, that $4,000 is a big deal, right? It's completely missing the $4,000 generated by the asset. So to the extent that $4,000 is going to be important, the historical balance sheet is just missing that now. Okay, what we want is a market value. Instead of looking at these historical numbers, we want to figure out what stuff is worth to investors. How much are investors willing to pay for the equity? How much are investors willing to pay for the debt? That's going to tell us how much the asset is worth. Right? This kind of historical cost accounting is only a very rough approximation of that. Okay, so let's see how we can infer the value of the asset, the economic, the market value of the asset based on the value of the debt and the equity. Okay, so same exact company. This company is going to expect to get those $4,000 every year going forward. Okay, and it's going to continue to pay those $3,000 in dividends each year forever, and make $1,000 in interest payments each year forever. Okay, so those cash flows that we saw in year one, we're just going to say those are going to happen all the time now. The bonds have a yield to maturity of 10%, and the expected stock return is 18.75%. So the question is, can you build a market value balance sheet for this company? So let's set up the balance sheet again, but now we're going to look at the market value. Let's focus on, say, equity first. Okay, what's going on with the equity? How could we value that? Well, we look, this company is going to pay a $3,000 dividend every year forever. So what does that look like? Well, it's a perpetuity, right? We're obviously just very simple, making a big simplification for what's going on with the equity. We're saying it is a perpetuity. the cash flow is $3,000 each year. And what should be the discount rate? Well, we said that the expected return is that discount rate, right? That's synonymous with the discount rate, with the opportunity cost of capital. We're using these things all synonymously in this course. So the expected return on the stock is 18.75%. That's going to be the discount rate. So we know how to value that. We can value a perpetuity. The value of equity is the discounted value of all the dividends. If it's a perpetuity, then the equity is just dividends divided by RE. That's $3,000 divided by 0.1875. You can plug that into your calculator and get 16,000. So this would be the market value of the equity. This is what investors should be willing to pay for the stock. You're going to get $3,000 every year, and your expected return for that stock is 18.75%. So that's a market value. That's what you're expecting. That's how much an investor would be willing to pay for this company's equity. Okay, let's turn to debt now. In this very simple example, debt is also described as a perpetuity. It's going to make $1,000 interest payments every year forever. Okay, and that's the only cash flows that we're given for the debt holders. So it's a perpetuity. If these are the payments, how do we find the value of the debt? Well, just like we saw with our bonds lecture, we discount the interest payments by the yield to maturity. So we can value the debt by discounting the the coupons by the yield to maturity. So that's going to give us a value of the debt of $10,000. And again, this is a market value. The yield to maturity is set in the bond market. That's what people are willing to pay here. So you get $10,000 in debt. Okay. So what would be the total market value of this company? Well, we've got $10,000 in debt, $16,000 in equity, so the total value must be $26,000. That's what all the investors get. We know that assets have to equal debt plus equity. That's the balance sheet identity. Assets equals debt plus equity. So if debt and equity is 26, then we know that all the assets have to be 26,000. Okay. Now the last thing we have to do is figure out how much of that $26,000 is from the assets, the machine that they bought, versus cash. Okay. So how can we sort this out? Well, this is one case where accountants can do pretty well. Accountants can look up a bank account and see how much cash is there. That's not so hard. The market value of cash is the same as the book value, right? So that's something where there's no divergence, right? If you've got $1,000 in the bank, how much is that worth? Well, that's worth $1,000. So in this case, we look up at the book value, and we know that there's $1,000 left in the bank. So that's also the market value. Okay, so that's easy. That's kind of, once you see it, it's obvious that that's true, that the market value is equal to the book value of cash. But maybe if you didn't see it for the first time, it may be a little bit tricky to think about. So if the cash is 1,000 and all the assets are 26, that means that the machine is worth 25,000. And that's it. That's the market value of the balance sheet. What we did is we had information on the debt and the equity, and we were able to infer the value of the asset because we know that assets equals debt plus equity. Okay, and here's all the work that we did. We just were super simple, treated debt and equity as perpetuities. Once you know that, we're able to use the accounting identity here to figure out the value of the assets, where assets are cash plus the operating assets. Right? We have two assets in this example, cash and the machine. So we can figure out that the operating asset is debt plus equity minus cash. Okay. If you compare the market value balance sheet to the book value balance sheet, you see a pretty big divergence, right? The company is worth $26,000 in market value terms. That's what investors are willing to pay. But historically, investors only put in $10,000, right? So you'd say the investors only valued it at $10,000 when really they're valuing it at $26,000. And this is a very pervasive problem. So if you look at the stock price of Amazon, for example, we can see how much are investors willing to pay for Amazon. You pull up Yahoo Finance and you see the market cap here. That's how much investors are willing to pay for Amazon's equity. It's about $1.6 trillion. Okay, so on the balance sheet here, Amazon's equity would be 1.6 trillion. That would be the value of their equity. Now, if you look at their book value, however, how much is the company worth? Well, it's only worth about $225 billion. Okay, so the book value up here would be $225 billion. The market value would be 1.6 trillion. So it's a 5 times difference. So similar here, here's a 2.5 times difference. Our book value was 10,000, market value is 26,000. This is not unusual, right, to have this huge divergence between the historical numbers and the market values, because the market values are looking into the future, and the future is very different than the past. Okay. That brings us to something called the enterprise value. So this is a new word. We're going to be using it over and over again. This is the value of the company's operations, right? So it answers the questions, how much money could we get if we sold a line of business? In our example, that's going to be the machine, right? That's what you're actually doing. You're generating cash flows using this machine. So how much is that machine? How much could that machine be sold for? That's $25,000. Okay, that would be the enterprise value. So we're making a slight modification to the accounting identity. Instead of having assets equals debt plus equity, now we have, well, we still have assets, but we're breaking the assets into 2 pieces, the enterprise value plus the excess cash. That together is equal to liabilities plus equity. Okay. Now, why are we doing this? Well, this excess cash, this is not part of the company's operations. So the kind of quintessential example here is Apple. Apple has iPhones. That's their operations. They make a lot of money by selling iPhones, but they also just have a ton of cash on their balance sheet. They've got hundreds and hundreds of billions of dollars just sitting in Ireland, kind of for tax purposes. It's not part of the iPhone business at all. They made a lot of money on iPhones, and they took all that money and they stuck it in Ireland. You know, so it's in cash now as a result of the iPhone business, but it's not used in the iPhone business anymore. Okay, so if you're trying to get at the value of Apple, you have to recognize that the iPhone business is separate from the cash, and cash is pretty easy to value. We don't really care about cash. We want to separate that from what we're interested in, which is the operations of the company. Okay, so same thing in this case. If this cash is just sitting here, it's not generating any cash flows. All the cash flows were coming from the machine. We weren't using the cash at all. So that cash would be considered excess. We're going to set it aside. It's not part of our operations. So we can value the enterprise value by just doing some algebra here. If we have this identity, that's going to imply that the enterprise value is liabilities plus equity minus the excess cash. So that's all that we're doing here. And so in our example, the enterprise value would be the $25,000. That would be the value of the operations machine. All right. So that was one way to find asset values. If you can look in the stock market, you see the value of the equity. You can look in the debt market, find the value of bonds. That tells you the right-hand side of the balance sheet, and then you can infer about the left-hand side of the balance sheet. That's not the only way to go. And sometimes it's not going to help us at all. So in this case, you only have one asset, right? So you can value one asset just by looking at the debt and the equity. Oftentimes, you've got a big firm, however, and you've got lots of projects, you've got lots of assets within that company. And if you're, say, a middle manager or a CFO, you're trying to think about valuing one individual project. You're not trying to value all the assets in the company. You're trying to value one individual project and decide, should I do it or not? Well, to do that, knowing the value of all the debt and all the equity isn't helpful. What you need to do is what we're always going to do is you need to forecast cash flows for the asset and find a discount rate for the asset so that you can put those two things together. Right? You need to discount the cash flows by the discount rate. Okay. So this is something called the discounted cash flow method. Okay. And we're going to spend a lot of time on this. Right now, I'm just going to preview it very, very broadly. Okay. But this is where we're going. Okay. So don't worry if things seem a little bit fuzzy the first time you see it. Don't worry about it. We'll be practicing a lot going forward. So, in 2 quick sentences, the value of an asset can be determined by discounting its cash flows. What rate do we use? The rate is going to be determined by debt and equity. It's going to be determined by how much the debt holders require and how much the equity holders require. That whole thing, those 2 sentences together, is called the discounted cash flow method. That's what we're going to be doing in this semester. So again, this is just foreshadowing where we're going over the next couple months. We're going to be forecasting the cash flows. We're going to spend a lot of time on that this week. And then where are we going to get the rate from? Well, we'll have a couple different ways to do that. Something called the weighted average cost of capital we'll see much later in the APV method. We'll see those much later too. But the whole idea is we're going to be discounting future cash flows by the appropriate rate. And then once you know the value of the assets, then you can try to figure out the value of the equity. Okay, so let's turn back to our example and do that here. So we're going to go back to company A here. They bought this machine. It's generating $4,000 per year. If we have a discount rate, then we can value it and get the enterprise value that way. Okay. So for now, let's just assume that the discount rate is 16% for the asset. We're going to come back to that and figure out how exactly did we get that. But for now, let's just say the discount rate on the machine is 16%. Well, if the cash flows are a perpetuity, you're getting $4,000 per year forever, then we can figure out the enterprise value of the company as the $4,000 divided by the 16%. So that's $25,000, right? That should look familiar. That's exactly what we got up here. Okay. Now I just pulled this 16% out of the air, so we still have to come back to that, where this rate is coming from. But for now, this is something you could do. If you have the cash flows and you have the discount rate, you can find the value of the assets. Okay. And what this lets us do is this lets us move in the opposite direction. So if we recall up here, when we were filling out the balance sheet before, what we did was we found the value of the debt and the value of the equity. We put those 2 things together to figure out the value of the asset. Well, in this case, we can go in the opposite direction. If you discount the asset and you get the enterprise value of $25,000, you can then infer the value of the equity. So if I know that the cash is $1,000, the asset is $25,000, and I see that the bonds are pretty easy to value, those are $10,000, well, that means that the equity must be worth $16,000. Okay, so if you can infer assets from debt plus equity, then you can infer equity from the assets. Okay. And this is what analysts do. So if you see analysts writing a report for Apple, what they're doing is they're trying to discount the cash flows for Apple by the iPhone kind of discount rate, the risk on the iPhone business. Once you do that, then you can infer how much should Apple's stock be trading at. And then the analysts would write a report and then they would sell it to their clients and say, I think that the stock price of Apple should be whatever, $200. And then if it's trading at $150, the analyst would say you should buy it, right? Or vice versa. So let's talk a little bit about where this discount rate came from. We said that it's determined by L plus E. It's going to be determined by the debt and the equity. There's kind of a lot of algebra going on the slide, so it's kind of there for your benefit, but you don't have to look at it right now if it's too much text. The main idea goes back to the balance sheet identity. Right? Assets equals debt plus equity. We're going to rewrite this, though, in terms of returns. Okay, so instead of having the assets cut up between debt and equity holders, the return on the assets is going to get divided between the return on to the debt holders and the return on the equity. Okay. Now, it's not quite right. What we have to do is we have to weight by how much of the company is owned by debt holders versus equity holders. So this is how you divvy up the returns from the assets. The debt holders are getting some return, RL. The equity holders are getting RE. How do you divide RA into those two pieces? Well, you split the return on the assets based on how much of the company each claimant owns. So L divided by L plus E, that's how much of the company is owned by debt holders. E divided by L plus E, that's how much of the company is owned by equity holders. Okay, but in total, these things have to be equal. Anything that you pay out to your debt holders and the equity holders, that has to be generated by the assets. Okay, and so you have to weight the returns to the debt and equity holders. That's got to sum up to what the assets are getting. So back to the 16%, I said that we're discounting these cash flows by 16%. Where is that coming from? It's still a little bit of a problem. Well, what's going on with the debt and the equity in this example? We saw above that the equity is getting a return of 18.75%, and the debt is getting a return of 10%. Okay, that was the yield to maturity on the debt. The equity is 18.75. The equity was worth $16,000. The debt was worth $10,000. So we're going to use this information about debt and equity to figure out the right discount rate on the asset. So in particular, we had $10,000 for debt, and the total firm was worth $26,000, and the yield to maturity on the debt was 10. The equity was worth $16,000. The total company was worth $26,000. And the return on the equity was 18.75. So you put all of that together and you get this 15.38%. So this is the return on the assets of the company. All the returns are generated, all the assets are generating 15.38. That's getting divvied up between debt holders, they're getting this, equity holders are getting that. Okay, that's just algebra. It's just an algebraic reworking of the balance sheet identity. Okay, so we're almost to 16%, right? I said we got to figure out the 16%. Where did that come from? We're almost there. We're at 15.38%. That's the discount rate on all of the assets of the company. Okay. Now remember, we've got two assets. We've got the cash and we have the machine. Okay. So just like we divvied up the returns on the assets between debt and equity, well, we can also divvy it up between the cash and the machine, right? Remember that the assets are equal to cash plus the machine. So the returns from the assets get weighted between these two things. Some return on the cash, there's some return on the machine, and these get weighted by their valuation. So the machine was worth $25,000 out of the $26,000, and the cash was worth $1,000 out of the $26,000. And the entire return on the assets has got to be 15.38. In this example, what return was the cash generating? Well, it wasn't returning anything. It was just sitting there, right? We didn't do anything with it. It didn't say that it was generating any cash flows. All the cash flows were coming from the machine. Okay, so in this case, the return on the cash was just going to be 0. Okay, so we'll replace that with 0. That whole thing turns out to be 0. And that lets us solve for the discount rate on the machine. The appropriate rate on the machine should be 15.38 times 26,000 divided by 25,000. And if you had to guess, what is that going to equal? Well, that's going to be 16%. So we went through it kind of fast, a little bit of a whirlwind here, but the idea is we're still using this accounting identity, assets equals debt plus equity. We're just rewriting it in terms of returns. We're going to figure out what should be the appropriate return on our assets. Our operations should be earning 16%. That's how this works. That's how everything's going to work together. The operations are earning 16%, so therefore they're worth $25,000. That's consistent with the debt earning a 10% return and an equity earning a 18.75% return, right? It's all got to be consistent. Okay, so again, everything circles back to this balance sheet identity. And again, if it's fuzzy, don't worry about it. We're going to see this much more going forward. Yeah, so it's not a coincidence. It's just algebra. It's just everything's got to work out consistently. Whether you're valuing the debt and the equity first and then inferring about the asset, or you're valuing the asset and then inferring something about the equity, it's all got to mesh. So that brings us to where we're going. We're going to value the company's operations by estimating its cash flows. Again, that's going to be the emphasis of this week. And then we're going to find the appropriate discount rate for those cash flows. That's going to be the focus kind of going forward into the future a little bit further. We'll talk about free cash flows in the next lecture. That's going to give us the cash flows from a project. And then we'll talk about how to get the discount rate. The end result is something called the discounted cash flow model.